Occupier Services webinar. We wish to acknowledge that we operate on the lands of the Gadigal of the Eora Nation, the traditional custodians of the land. We pay our respects to their elders past and present and to the emerging leaders. JLL's purpose is to shape the future of real estate for a better world. JLL has committed to reduce absolute scope 1, 2 and 3 emissions by 51% by 2030 and by 95% by 2040 from a 2018 basis year. JLL has also committed to achieve a net zero operational carbon emissions across all JLL offices by 2030. We're fortunate enough today to have Nikki Landsberg as our keynote speaker today, who will be delivering a comprehensive overview of the upcoming climate change policy in Australia. As an expert in sustainability, Nikki brings a wealth of knowledge and experience to this topic. Nikki is a partner with EY's Climate Change and Sustainability team and the co-lead of their Sustainability Disclosure Hub, which has been established to support Australian businesses prepare for their new climate reporting and assurance requirements. I'll now hand over to Nikki to provide an overview of the climate change policies.
Thanks, Tara. And hello, everyone. Great to be here today. Really excited just to maybe spend a few moments giving a little bit of a current state where we're at, stock take of the new policies that are coming through for mandatory climate disclosure and what that means for businesses today. So you can see here a little bit of an overview as far as Treasury's new proposed bill that's currently with Parliament that we do anticipate will be passed very soon. It has an effective date of 1 January 2025. And essentially will require a range of businesses that you can see here, grouped into 3 different groups in the sort of next couple of years to prepare a sustainability report. Now, I know many entities are already preparing a sustainability report, but this will be a requirement, something that these entities up here on the slide will need to do. And it will need to sit within and as part of the core filings that you do within the annual report for general purpose financial reporting. Treasury has set the expectation at the moment that this requires disclosures of certain climate information, so covering certain climate related risks and opportunities and what entities are doing to manage for those climate related risks and opportunities. But we do actually anticipate that those disclosure requirements will extend beyond climate to other sustainability topics. Now, the reason for this is that the Australian approach has been to take the new international standards that have come through from the International Sustainability Standards Board. I apologise, there are lots and lots of acronyms, so I will try and spell them all out. But the ISSB has been established by the IFRS Foundation to really bring together a range of different standard setters, guidelines, framework setters and the like to develop a universal suite of sustainability reporting standards, really targeted to a shareholder or investor audience. At the moment, they've issued 2 standards, a general reporting requirement standard and the first topic standard around climate. But they've also just announced that their ambitions for the next topic standards are around human capital and also around biodiversity, ecosystems and ecosystem services, or BEES, which is my favourite acronym.
Love the Bs.
Love the Bs. So we do anticipate that the Australian, so Treasury will adopt these future standards in due course. But for now, at least, starting 1 January next year, we will start to see businesses need to prepare a sustainability report targeting certain climate statements. The other thing I did want to note just here before moving on is that this does require a director's declaration. And so really mimicking or following that sort of robust rigor around financial reporting and applying that to sustainability reporting. And I think something that we are definitely hearing from many, many boards is absolutely on their radar. So what specifically will we need to report? So you can see here a little bit of a summary around those core content requirements of the ASRSs, or the Australian Sustainability Reporting Standards. Now, this might also look a little familiar to many of you in that it follows the framework that was established by the Task Force on Climate-related Financial Disclosures, which looked at this sort of governance, strategy, risk management, and metrics and targets approach. So starting with governance, here really, what is the board and what is the management team doing of an entity to oversee climate-related risks and opportunities? What is their role as far as reviewing targets, setting strategies, identifying, assessing, evaluating different climate-related risks and opportunities? The expectation ultimately being to describe those processes that are in place and how aligned they might be to things like executive remuneration. I'll skip over strategy and I'll come back to that one. But risk management, here it's really about the process. So what is the process that an entity has to, again, identify, assess, and manage climate-related risks and opportunities? We expect that a lot of disclosure here is going to follow existing sort of enterprise risk assessment processes that you might already be looking at in certain disclosures around annual reports or corporate governance statements. And I think the reason for that is that we do expect, or these standards essentially setting the expectation that the assessment of climate risk should be embedded or integrated into that sort of core risk assessment process that an entity has. Now, the outcomes of that, so what are your climate-related risks and opportunities, sit within that sort of strategy bucket that you have up on the top right-hand side there. So what we'll need to look at is, what are the potential physical and or transition risks and the opportunities that a client faces, or an entity, faces with reference to climate change. So again, that could be, for physical impact, something around, storms, flooding, bushfires, an excessive amount or a growing amount of, hot days, or on the transition side, what are the impacts as far as, policy change, the introduction of carbon pricing, potentially technological changes that, make, certain products or services redundant. So really, what are those impacts to the business? And I think traditionally, most have sort of followed the impact of the business when they're reporting on things like climate change. But this is really about that impact to the business. And the reason that it is about the impacts to the business is because of this sort of, third point that we have up there in the strategy box, which is around the current and anticipated financial impacts. And so this is really the crux of what these standards are looking at, in that, what is the value at risk ultimately over the short, medium and long term? What is the potential impact on an entity's prospects when it comes to climate change? And really the ask is, how have we done that sort of stress testing or scenario analysis to assess the climate resilience? And then there's the final pillar here, which is around metrics and targets. So how are we measuring progress? How are we, tracking against targets and the like? And I'm sure we will come into discussion around all things greenhouse gas emissions and scope 1, scope 2, scope 3 emissions. The other thing, just to kind of briefly mention from a policy perspective onto the next slide, is around the assurance requirements. So whilst Treasury has set this requirement for entities to report, they've also introduced the requirement that they have assurance of this information. And so there's a proposed or an example pathway up here that the ASB, so the Auditing and Assurance Standards Board, is developing. This may change, so it's not set in stone just yet. But ultimately, what we're seeing is that there will be this transition from a limited level of assurance, which is very common today, and particularly for those that might be, getting things like their anger reports assured, but moving into that sort of reasonable or financial audit level of assurance, and really extending out to all of the climate disclosures that will sit within that sustainability report. So I think something just really important to recognise that not only will you need to be preparing these disclosures and obviously undertaking certain management activities to get ready for that reporting, but you'll also need to get ready for the assurance that overlays that. Now, I just maybe to spend a few kind of brief moments on, what do we see other entities doing to prepare? And there's, two key component parts of this. The first is to look at, what are the gaps to where we're at today? So how do we prepare for those new reporting requirements and doing things like gap assessments against the sort of specific disclosure requirements set out within the standard. And really to kind of set that pathway for where do I need to act and when should I do that? The other key part of that is bringing as many people as possible into that project team. So this shouldn't just sit with finance, it shouldn't just sit with sustainability. Bring as many people into that project team as possible and really get, share the load, but also get as many different perspectives into what we need to do. And then the sort of second component here is around implementation. So how do we implement those actions that we've identified from the gap assessment from a reporting perspective? But equally, what are the integration considerations? And I mentioned this for risk and for the risk management process, but really right across the board here is how are we embedding the management of climate-related risks into the business? So how do we consider that when we're setting our strategy? How do we consider potential climate risk when we're thinking about financial planning or budgeting processes? How do we, think about climate when we're setting executive remuneration and particular targets there? So really it's about that embeddedness. And that again is really the sort of key reason that we need that sort of cross-functional project team. So I might just leave it there, Tara.
Okay.
I know we've got lots and lots of questions, and we can go from there.
Yeah, awesome. All right. Well, thank you so much, Nikki, for providing us such a comprehensive overview of the upcoming climate change policy. Your insights have definitely shed light on the potential implications this policy may have on the business and how occupiers can navigate this. We'll now move on to our panel discussion, where we'll delve deeper into the specific effects of this climate change policies on the respective of organisations. We've had a panel of industry leaders who bring diverse perspectives and experiences, enabling us to explore these implications from various angles. Throughout this discussion, we'll be answering questions that have been sent through prior to the registration process. So if there is anything that's not answered in today's forum, please do feel free to reach out. So it's now my pleasure to introduce our panel. Firstly, we have our Nikki Landsbergen, whom we've just had the privilege of hearing from. Nikki is an expert in the sustainability and environmental regulations, and her deep understanding of the upcoming policy change Australia has undoubtedly enriched this conversation. Joining us on the panel is our very own Connor McCauley. Connor heads up our sustainability team across JLL for both Australia and New Zealand. And completing our panel today is Christopher Cormack. Chris leads our new energy team for JLL, assisting clients with their transitions. So Nikki, I might throw to you first, if that's okay.
Sure.
There's new reporting standards that are still very new, and companies are trying to figure out what it means for their actual business. At what stage are some of your clients at, and are some industries ahead of others?
Really good question, Tara. And absolutely, there's a really, really broad spectrum of preparedness for these new reporting requirements that are coming through. So we've had numerous companies voluntarily report against things like the Task Force on Climate-Related Financial Disclosures, that TCFD framework, particularly large listed entities, perhaps across the ASX 100. But I'll say that TCFD still won't even get you all of the way there to the new sustainability standards that are coming through. So there's still a gap that we see a number of those entities, but they're very well prepared because they've already spent some time undertaking the climate risk assessment, measuring their scope 1, scope 2, scope 3 emissions. And as a consequence, I think, really leaning into sort of enhancing the quality of that reporting and their underlying processes. Now, in contrast, there's still a lot of companies that are, I think, coming to terms or recognizing that they will have mandatory reporting requirements and are really starting to just get their, hands around this and what that means. So we have a number that haven't needed to report under things like the Angus scheme and are just now starting to look at, what are their scope 1, scope 2, scope 3 emissions and, what should they be thinking about when it comes to climate change. So there is a really, really broad spectrum. I would say from an industry perspective, those that I'll say, most obviously impacted by climate. So in mining, in energy, in real estate as well, are potentially a little bit further along that maturity curve than others where potentially their impacts are more further embedded into the value chain, and as a consequence are not really or haven't needed to be kind of as on the front foot with the more voluntary basis of reporting. So yeah, very broad spectrum ultimately.
Connor, you're leading this implementation on behalf of JLL. What stage is JLL at, and what are some of the challenges or risks that you foresee?
So, look, we're all done. JLL's in a great position. Yeah, I started looking at this a few months ago. I picked up the phone to Nikki and said, "Oh, what do we need to do here?" And I was just like, "Oh, we're sorted." No, look, not really. As you know, JLL's part of a big global business, and I think as Nikki touched on, a lot of those larger, multinational companies or sort of Australia's listed companies have been doing some level of climate risk reporting, and also emissions reporting in their sustainability report or within their financial statements for a number of years. And JLL's the same, but I guess what happened with this new disclosure and sort of the Australian requirements is that we need to now report on that from an Australian entity perspective. So where are we at the moment? We're definitely going through an internal consultation and education piece. So I think what Nikki mentioned around trying to set up that multidisciplinary team, we're talking to our risk team, finance team, different business line and leadership members to help them understand what these new disclosures mean, and then really looking at it through the lens of, I like that term you said that before about value at risk. We're a services company, but we need to now look at longer term. What are some of the risks that we're going to see play out in the real estate sector and sort of the service industry, but then more so what I think for us are some of those opportunities. So I'd say that the real challenge for us is to not just make this a box ticking exercise, but align it with our strategy for our Australian business, and then see how that can help us, sort of navigate and really understand what the opportunities are.
Yeah. And I guess, Connor, those who are listening to New Zealand, I guess, are we following that over there, or where are we at New Zealand-wise?
Yeah, definitely. So New Zealand and a lot of other countries are stepping this up. So, I mentioned before, we're doing this at the global level, also in Europe, in the UK, and sort of my counterparts in different geographies all around the world are now we're required to, but Nikki might be able to answer better than me, but I think Australia is one of the earlier adopters in Asia Pac.
Yeah. Okay, fantastic. Thank you. Chris, I'll jump over to you. So how should businesses, I guess, be approaching mandatory reporting, and how does it cross into their real estate decisions?
Yeah, good question. So look, I guess a lot of people are doing this voluntarily already. So for most of the people that we work with, this is not a new thing necessarily, but it's going from something that was voluntary before to something that's mandatory. So it's now kind of embedding these decisions into your full kind of property strategy, full company strategy. So, it's really starting to become a serious thing, I guess. So from my perspective, there are some things that you can do quite easily that can make a difference to the overall profitability of your business. This is not just about reporting on emissions and offsetting anymore. There are a lot of things that you can do from a new energy perspective. Solar PV is always part of the discussion, especially when it comes to industrial real estate. But there are new things that are coming online now. The transition to electric vehicles, for example, transport emissions, if you haven't looked at those as part of your Occupier portfolio, are going to become a real thing over the next little while. But there are definitely ways to approach this that make sense from a strategy perspective, but also help you to mitigate your climate risks.
Yeah, fantastic. Okay, I'll put this one out to the panel. So what are the potential climate-related risks to businesses, operations, or their assets? Are businesses considering these risks? And if not, how can we encourage them to do so?
Good way to start. So I mentioned there's sort of this, transition and physical categories ultimately of risk. And I think, in property in particular, there has been an appreciation and, Chris, you mentioned this around some of those physical impacts, I would say. And, when we're looking at development work or when we're looking at, locations, there are those considerations. And I think many have been making, maybe not in the, I'll say, name of climate change, but, factoring in things like the weather impacts and, could there be risks of, an increasing amount of flooding or bushfires? And so those types of risks, those physical risks, I think we're getting much better understanding of what that looks like, and particularly what that looks like under different climate scenarios. So, what would happen under a 1.5 degree scenario when we took, strong action against climate change and we really limited the amount of greenhouse gas emissions going into the atmosphere, and as a consequence, potentially or hopefully reduce some of those physical impacts. Vis-a-vis if we kind of let things go and what does a 4 degree scenario look like. So I think we're getting a much better appreciation of that. On the transition side, again, we've kind of, I think, done it a little innately in looking at managing for energy cost and, looking at, let's say, de-risking our exposure to those energy price rises through, solar and, other forms of renewable energy. But I think there's also this kind of growing sentiment around reputational. And when we think about our people and our customers, but also other partners in the value chain, we're starting to see a lot more focus on, what are those potential reputational consequences to my business? And as a consequence, how should I therefore be, leaning into and responding to some of those risks?
And I think if I can add to that as well, I think from a transition risk, the big one for me is that reputational one. I'd say, we've been talking a lot about, greenwashing in our industry, and, even in the Australian government, they're looking at, ASIC are pulling up the curtains on a lot of different companies at the moment and really diving into some of their claims around sustainability or ESG. So I think that is potentially, I know for JLL and for what we're advising our clients, one of our biggest risks there, just because there's going to be more scrutiny. I'd say actually off the back of this new mandatory reporting, with more transparency and data being shared openly about companies' transition, to a low carbon environment, and their reporting of scope 1, 2, and 3 emissions, people will be able to lift the hood on it a bit more. So I think that's really a big one for me. And as you mentioned, I'd say, look, we're targeting this more towards industrial occupiers. You mentioned physical risk before. For me, that the flood risk, bushfire risk as well, are big ones for those occupiers that have big warehouses or operations in city and urban areas that are prone to flooding. So definitely something that's more sort of front of mind. But I'm more inclined to get down the transition.
Yeah. I'm look from a transition perspective. Obviously, you've got the energy transition that's happening at the same time, and I guess we know that from a renewable energy development perspective, things aren't going as smoothly, and as there's not as much being done especially in the large scale renewable space. And what is coming next really for industrial occupiers is a race to grab hold of green electrons, right? So that the green electrons are going to be like a key part. One example or a good example might be AI and the move to data centers, which is obviously a big theme, in the industrial property space at the moment. The inputs there are, chips, property, and green electrons, effectively. We don't really want to get to a situation where we're putting data centers right next to coal-fired power plants, for example. That is, big climate risks, effectively. So a strategy around, where you're actually going to get your energy from, which renewable sources, how you partner with developers, is going to be a really important way of looking at things in the future. And these mandatory risk reporting in situations are basically going to bring much more focus on that.
I'll put this one out to the panel as well. So I guess we've discussed in quite some detail around the climate-related risks. What do you think companies need to be doing to measure and reduce their carbon footprint?
Yeah, I can
You go
start.
first.
I can start off here. So it's the easiest way, and yeah, Nikki deals a lot with balance sheet and financial numbers as well. But it's go to your finance team. I think at that starting point, really to understand where your business is creating direct carbon emissions. Go to the finance team, look down the general ledger, understand where there's costs around electricity, gas, or other fossil fuels. And that can be directly translated into your direct scope 1 or 2 emissions. Scope 3 is a lot harder, but again, the information is held in what you're spending your money on.
Yeah.
So again, looking at both upstream and downstream, pretty much every part of what your business is spending money on, whether what you're procuring directly to create a widget or a product, and then what's happening downstream. There's a lot of information and a lot of consultants around that can help you actually do the number crunching and switch it in. But I think that's where you start off with, is just really understanding what your direct emissions are, and then what your indirect are, and looking at your supply chain.
Yeah.
Yeah, I mean, and the next step from our perspective is to have a look at your assets and see, how much, gas and electricity you are using, what the kind of age of some of the HVAC and some of the, some of the stuff that, is kind of JLL's bread and butter. We have people who can help with that if that's, one of the things. But I guess overall, you've got to look at your full strategy. So, it comes down from company strategy probably to the next stage, which is the climate change strategy, and then having a look at each of those assets.
I might just add to that in terms of particularly the scope 3 piece. And, Connie, you mentioned this as far as measuring, starting with, where it is that you're spending ultimately in your value chain, and, particularly from a procurement perspective. And there are some, I'll say, easier methods that you can start with as far as, taking that spend data and applying more proxy-based emissions factors to get a handle of where are those hotspots within your value chain for what those emissions are. I will say very quickly, you do need to move to starting to talk to those business partners, because if you stay at that level of, measuring emissions based on spend, the only way to manage those emissions is to reduce expenditure, which could mean, sourcing less or, potentially, not procuring, certain items, which is obviously not what you want to be doing. So, make friends, make friends fast, and start working together, because I think the best way that you're effectively going to be able to manage those emissions in your value chain is by working with your partners in your value chain.
And I'd say as well, we're looking at this for our clients, so we do a lot of procurement on behalf of our clients as well. There's a lot, it's in the hundreds of millions of dollars that we do procurement for, but the easier way is really just to use that 80-20 principle. So who are you spending the most money with, and then engage with them. The chances are, if they're a large cleaning, security, waste management company, they're probably someone else's large cleaning, security, waste management company. So engage with them, understand how they're reducing their emissions, and try and start getting direct emissions data from them, so it's not just based on how much spend it is.
Yeah, and obviously the key relationship in property is always the tenant and the landlord. And, look, we always encourage that to be, a strong relationship in terms of carbon emission reduction. Look, there's some really good examples of things that are going on in the industrial space. We've seen Dexus announce that they're going to put solar and batteries on every new development that they're doing in this space going forward. So I think that's a great example. And from my perspective, it doesn't make sense not to put solar on anymore. Batteries are still, coming down the cost curve, but they're getting much closer to being something that is, going to make sense just from a strategy and finance perspective, even regardless of the climate.
And I might lean into that a bit more. I'd say, from a property perspective, it is about those upfront discussions between landlord and occupier. When you're looking to either stay in your current place or move to a new one, that's the time to have these discussions around what, in the heads of agreement or in the lease around energy efficiency. So who's going to, is there an opportunity to co-invest on energy efficiency within your warehouse? Rooftop solar is another good one. You know, who's going to fund the battery storage or enable EV charging for your fleet as well?
Yeah, absolutely. All right, well, look, we're probably on to our final question for the panel. So it's a strong one. So if businesses had to focus on certain tasks over the next 6 to 12 months, what would you recommend?
I'll start. You know, I do think emissions reporting is very important. But if you haven't started, definitely start with that climate risk assessment. And there is relief in that you can start with a more qualitative form of analysis rather than looking at some of the quantitative modelling when you're looking at those different climate scenarios. But really just start with that. Make sure that there is, again, this sort of cross-functional project team that's involved. So get strategy, get risk, get finance, get sustainability, you know, potentially also get some of your supply chain or business partners involved in that and have a really, really robust discussion around what are those potential climate related impacts. And then use the risk framework to understand, okay, well, what is the potential consequence and likelihood of those under those different climate scenarios to really use and set the direction of where you need to go. So where do you really specifically need to target, you know, activity and investment and resources, because otherwise I think you'll find that you're just trying to do too much.
Yes.
I think for me, it's two things. One is, first of all, you know, speak to your leadership team. They might not be aware of this, even though a lot of people are talking about it. You know, it's really important to engage with them, and I'd say what Nikki said as well, get that cross-functional team together. But then educate yourself. There's a lot of available information out there. You know, we mentioned before that a lot of large companies have already been reporting against climate risk through this task force for climate-related financial disclosure for a number of years. So Google, you know, someone else in your supply chain, what a big ASX listed company, for example, type in their name and TCFD and it'll come up with their report. Have a read of that. And then also go to the tcfdhub.org. Lots of really useful information around that, even though the Australian version's, you know, nuanced differences there as well.
Yeah. I mean, I just reiterate, get educated effectively. You know, in the process of researching to do this webinar, I've learned a lot about what's going on, and quite surprised how serious actually the next stage of reporting is going to be for Australian companies.
Fantastic. Okay. All right. Well, thank you, Nikki, Connor, and Chris for your valuable contributions today. Your insights and expertise has definitely been undoubtedly enriched with our discussions. So a big thank you to all of those who joined online for our first ever Industrial JLL Occupier webinar. We will be hosting a follow-up webinar to talk through how JLL can partner with you. So please stay tuned for more details to come. Thank you very much.
Thank you.
Thanks, Tara.
Thanks, Tara.
Thanks, Tara.